Hello and welcome back to the program. Let's get right into what happened overnight in the US markets. The three major indices finished essentially flat, with the Nasdaq closing at 26,130, the S&P 500 at 7,675, and the Dow at 53,463. Gains and losses were negligible across the board, and the market is clearly in a high-level consolidation phase. But here's where it gets interesting. Pre-market futures are showing some divergence. Nasdaq futures are up 0.37%, S&P futures are basically flat, while Dow futures are down 0.4%. That tells us capital is rotating between indices rather than fleeing the market altogether. This is not a broad risk-off move. Now let's talk about the stock that everyone is watching. Nvidia closed at $209.66, down 4.5% on the day. That's a significant drop, but it hasn't triggered the 8% mandatory verification threshold. And here's the thing, we don't have independent sources confirming a specific catalyst for the move, so we're marking it as pending verification. What's notable though is that Nasdaq futures did not follow Nvidia lower in pre-market trading. That suggests money isn't leaving the tech sector, it's more likely rotating within the compute hardware space or shifting to other sub-segments. The tech ETFs QQQ and SPY were down 1.17% and 0.59% respectively, confirming the pullback in tech names. Moving on to our stock radar scan for today. The system is showing a bull market state with a risk budget of 0.8, which allows for both catch-up trades and strong breakout strategies to run in parallel. We have two opportunity candidates, both showing an upward bias with a probability of 55% and a time window of 1 to 3 trading days. First is SEDG, the solar inverter and power electronics company. It's up 10.71% over 2 days, pending verification. The trigger logic is based on supply chain bottlenecks in new energy hard tech, and the discipline is to observe, not chase. Second is SMTC, the semiconductor analog and mixed signal company, up 12.75% over 5 days. It's benefiting from data center and telecom infrastructure demand. Same discipline applies, observe and don't chase. Now for portfolio positions. 5802.T is 31% through its catch-up progress and showing relative resilience, so we continue to hold. HPS.A has zero catch-up progress but has reclaimed its 200-day moving average, also relatively resilient, and we continue to hold. AKTS is 85.6% through its catch-up with notable insider buying, continue to hold. POET is 94.2% through, and we recommend taking partial profits. COHR and AEHR have both reached 100% catch-up progress with significant insider selling, so we recommend scaling out in batches. AXTI is also at 100% with high geopolitical risk, take profits. And one name to avoid, VACR. The system flags its FINRA short interest ratio as excessively high, which makes it vulnerable to short selling pressure in a weak market. Now let's look at the macro picture. The 10-year Treasury yield is at 4.66%, down 4 basis points from the previous day. That's a marginal easing signal, but the absolute level remains elevated and continues to pressure growth stock valuations. The VIX is at 15.08, which is at the lower end of the normal 15 to 25 range, hugging the greed line at 15. Panic selling pressure is limited and market sentiment is leaning optimistic. The dollar index is at 99.17, below the 100 threshold, and a weak dollar is generally supportive for emerging market assets and capital inflows. Oil prices are moving up, with WTI at $82.52, up 1.1%, and Brent at 87.47, up 1.3%. We need to watch whether rising oil prices feed into inflation expectations through geopolitical disruptions. Gold is at $4,640, down 0.47%, suggesting safe haven demand is cooling slightly. Putting it all together, the global market is in risk-on mode. A weak dollar, low VIX, and firm Nasdaq futures are providing support. But the failure conditions are clear. If the VIX breaks above 17, or the 10-year yield pushes through 4.75%, this risk-on narrative will quickly reverse. On the currency front, the onshore yuan is at 6.7089, appreciating 0.16% on the day, while offshore is at 6.7192, basically flat. The yuan remains in a strong position. With the dollar index below 100 and the yuan appreciating, the probability of foreign capital flowing into shares is rising. On the trade and tech restriction front, there are no new verified events today. The main themes remain the AI chip export control list and new energy tariff reviews, with no incremental information. For today's A-share market, we expect a flat to slightly higher open. The Shanghai Composite gained 1.13% yesterday and the Chinext rose 1.71%, so momentum is carrying through. However, the Chinext needs to digest profit taking above the 3,900 level, so a sharp unilateral rally is unlikely. In terms of sectors, the first main line is power equipment and the power grid, where capital prefers certainty in a weak dollar environment. The second is high dividend defensive stocks, as global capital continues to favor cash flow assets with the 10-year yield still elevated at 4.66%. On the AI compute hardware chain, given Nvidia's drop and the unverified reason behind it, chasing today is not advisable. For northbound capital, with the yuan appreciating and the dollar weak, the probability of net inflows today is higher than outflows. So here's our core judgment for today. A weak dollar and low VIX provide a supportive backdrop. Shares are likely to be range-bound with an upward bias. Power equipment and high dividend names should outperform, while we need to guard against Nvidia-related volatility in the compute mapping names. Our probability assessment is 35% for an up day, 45% for consolidation, and 20% for a down day. That's all for today's program. Thanks for watching, and we'll see you next time.